Oh my God. What happened to stocks today? Because wow, we're at new all-time highs and we need to know what happened. That's exactly what I'm wondering today. We know the bulls have faced multiple tests and today's going to be no different going into tomorrow. Why? Well, have a look at the size of this gap. We're either going to come down for a gap fill or we're just going to keep marching higher. This will be a very important video. So please make sure you stay tuned all the way until the end. So we're still in neutral. We haven't really decided if we're going to go up or if we're going to go down. Here's what I find interesting. With a 46 yesterday and the market being up by nearly 1% today, something seems off here. People should be laying on the risk. And remember, we talked about 542 as the number for today, which was the option implied move. Where are we? 541.36. We basically hit it. And then we went higher and settled right around that number. So the market does not yet seem convinced it's time to go into greed, but we're seeing greed in certain stocks like the big guys. Microsoft, Apple, Nvidia, Tesla's even joining the party today, up by nearly 4. It's almost like people forgot that Apple is a really important company. Why? Well, because they've been buying it like it's like the money's going to expire. It's up by 9% in the last week. That's a huge move. So here's what happened today. At 8:30, we got a huge move on CPI. It looked like it was probably good enough. The numbers came in all red, which is good for stocks, notably the headline CPI coming in at 0.0. So that was really good. That was the first thing we saw. Then we got the dot plot. And what does the dot plot say? Well, this is where it can start to get a little bit confusing because some people just don't really understand how the Fed works. But here, I'll make an attempt. So we look here to the dot plot. This is basically their summary of economic projections. I've highlighted the two parts that I find important here. So they've actually raised their inflation forecast for this year and into next year for both PCE and core PCE. But now they're saying there's going to be fewer cuts. So we basically went from having, let me just delete it here, 3 cuts at the last meeting to now having only 1. It was pretty close between 1 and 2, but 1 did win. So what does this really mean? Well, it means we got a little bit of a hawkish reaction. And Jerome Powell actually also came in a little bit hawkish. He was asked a question about what would cause you to cut going into September? And he said, basically, I don't know, right? Not my job, not my department. This is a Wendy's. That's what I heard Jerome Powell say today. So if now we think about what really moved the market, it was 8:30, 2 o'clock, and then 2:30. So let's think about this. From the time we opened, we have an opening price on the S&P. That's at 9:30. The opening price was 541.63. Where did we close? 541.36. And after hours, we're just above that. So I would say that we opened up, gap and go, and we came back down and settled roughly where we opened. So this part right here is the exuberance. We have to find out whether or not we can actually break this inside bar bullish or if we're going to wash out and go fill that lower gap. We talked about this on the morning stream too. I'm actually quite surprised the knee-jerk reaction wasn't bigger. That's it right here. You can see it. It doesn't even look like Jerome Powell spoke today. This appears like it was less important than the gap up. Why? Well, look at the size of the hole here compared to the size of the move here. And then when Jerome Powell finished talking, which is pretty much on this candle, well, that's where sellers came in and said, all right, time to sell, time to take it down. And they weren't really successful, but a lot of individual names did sell off from the open. Here's what's interesting. So we see that QQQ actually has a hollow candle, which means it closed higher than it opened. And this is largely due to mega caps like we talked about. If we go here to sector and we look at the one-day performance, hey, it looks pretty good. However, if we now look at a 4-hour, which only looks at the afternoon, there's Mr. Red. Yes. So most stocks actually went sideways to down into the last 4 hours, which basically means the afternoon. So what we really have to think about here is whether or not we're truly seeing a broadening out or if it's just more of the same. And this is particularly important because we talked about this on the weekend. We talked about how we have a U.S. exceptionalism, S&P, NASDAQ, dollar, U.S. 10-year note all up. But we need to see RSP, XLF, IWM to join the party. And they did, but they didn't hold. So if we have a look here, RSP, it's throttling that number. So it closed out 0.5% higher, which is not as much as the S&P. So would have preferred to see it higher. I'm still unsure if this is a double top. We're only about a third to a half of the way through the month. So I'm not sure what's going to happen here yet. If we go over to XLF, this is where it does look double toppy though. Why? Well, look, we did not pass here. We're below the previous high, and that's just not good. I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up or subscribing to the channel, I would greatly appreciate that. Thank you ahead of time. So we did not really see that broadening out. And at least for right now, I'm still a little bit confused. When I look at this, again, listening to Jerome is one thing, but looking at, all right, so you guys expect higher inflation into this year and into next year. 2.3 is bigger than 2.2. 2.3 is bigger than 2.2. But you guys are going to cut more? This gets me confused. So they're going to cut 1 time this year, 4 times next year, and then back to 2026, it's back to normal. I'm confused. I don't understand this. They think inflation's going to go up and they're going to be able to cut. But look at the headlines we heard from Jerome today. Unemployment moved up a bit. That's an important statistic. So if we look here to the dot plot, they have unemployment here at 4% for this year, 4.2 next year, and then 4.1. So people are going to lose their jobs. Inflation's going to go up from where they forecasted back in March, but they're going to be able to cut. Man, this does not make sense to me. But what I basically heard Jerome Powell say was, if we get above 4.2, again, I'm reading between the tea leaves or between the lines. I heard him say, if we get above 4% for unemployment, that's going to signal a cut. Right now, we're sitting at 4. So we have to move higher more. People have to lose their jobs. The next one here was that Fed plan is to not wait until things break, then fix. Well, this is the part where it starts to get a little bit convoluted. And I'll show you the reason why. Because on average, I did this on average, going all the way back to 2000, the average pause is about 11 months. Well, we're already there, right? From August until June. Well, that's like basically 11 months. We go into July, it's been 11 months. They're going to wait till December. The longer they pause, the bigger the recession. This gray line right here, that's a recession. They pause for a long time. Ouch. If it's 1995 and they cut a few times, then wait. Yeah, there's still a recession. It comes later and it's not as bad. So this is what he's saying, but it's looking less and less likely. Maybe that's why the reason why the market sold off into the close. Let's see what Chris Waller said on May 21st. In the absence of a significant weakening in the labor market, basically this, right? People losing their jobs, 4.2%. I need to see several more months of good inflation data before I would be comfortable supporting an easing in the stance of monetary policy. All right, well, it still looks like it's 1995 because the market is only going mega big up. But as of right now, it looks like our final boss, we're not sure. We closed green, so we're not looking that bad. But I don't know what the market's going to do. Sometimes we can have a delayed effect between the Fed day and then the fallout day. So if we now look a little bit objectively here at the S&P, because we're going to be closing out the week in 2 days, we would have to fall back below 536 in order for there to be anything bearish here on the weekly chart. And we're still above our monthly higher high at 534. We talked about that resistance here before. 534, you can see it right there. So if now we focus on the daily chart, what does this really mean? Well, for me, it means that we're just looking for one simple pattern. It's an inside bar break. So tomorrow, I'm assuming we're going to open up inside this range. If we break the inside bar bear, I'll be looking for a gap fill. And then I want to watch the reaction. I don't want to tell the market what it's going to do. I want to react. If on the flip side, though, we do print a daily higher high, hey, the final boss got passed. There's nothing to worry about, nothing to sweat, and we're going to go dramatically higher. All right, that's it for today's video. So if you enjoyed it, please consider smashing the thumbs up, or maybe you want to watch the video on the left, or come hang out with me at 9:15 a.m. tomorrow for the stream. Thanks so much. I'll see you tomorrow.